to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa. If you find this video helpful, please press the like button and don't forget to subscribe to see our upcoming market reviews.
Good day and welcome. I am Nick from the Overberg Greater Office. Starting off with the most negative and gradually moving across. Got lots of different macroeconomists and strategists. We'll end off with what's quite positive and also a couple of specifics to do with the US economy, which I think you'll find are also positive. Cross-border capital, key points. They're still very cautious on the markets. Global liquidity is heading much lower. Investor exposure to stocks is high and out of line with deteriorating economies. So there's a graph going back 10 years, investor exposure index. So plus 50 is very bullish, minus 50 very bearish. And at the moment, investors, world investors, are close to the top end of the scale. And that's a bit of a worry. There's a high level of risk appetite still, despite all the potentially negative news about to hit the markets. Bond markets are screaming a warning, according to Michael Howell, and the US Fed Treasury agenda spells trouble. Federal Reserve balance sheet is going to shrink and the US dollar is going to strengthen. Two other negative drags. First, the impact of higher oil prices and then the strength of the US dollar, both of them depleting global liquidity. But this downswing fits exactly with a typical 65-month rhythm, often associated with a liquidity cycle. On that basis, global liquidity looks unlikely to bottom out much before mid-2023. Edison, slightly more tempered, and this is a quote, while the day-to-day narrative has been shifting between the war in Ukraine, the cost of living crisis, and China's COVID lockdowns, these are the crashing waves obscuring the movement of the tide. Monetary policy is being rapidly normalized, and as a result, abnormally high valuations are being progressively reset lower. We believe this process has further to run. We have a lot of investment, a lot of exposure to the UK in our global portfolios, and it's probably one element of the portfolios that is holding up our performance relative to global benchmarks. And the reason for the UK outperforming so strongly in 2022 is that the index is both relatively inexpensive on a global basis and has significant energy exposure. Moreover, very low exposure towards technology, which is extremely overvalued by some measures. And moreover, the UK market has got a strong weighting towards financials and healthcare. However, Edison, a fairly positive overall. In aggregate, global earnings forecasts remain stable for now. This is likely to limit the downside for global equities in the short term. ECR, we follow them closely. The executive summary, I'm quoting here from the executive summary, investors seem to assume that central banks will be able to regain control of high inflation without triggering a recession, i.e., investors are assuming a soft landing. However, soft landings are rare. In the months ahead, we expect more downward pressure on economic growth and persistent supply-side problems due to stricter lockdown measures in China. Inflation expectations will gradually decline, but core inflation will remain at current levels. The coming weeks or months are likely to see a further decline in equity prices and a widening in credit spreads. In recent decades, central banks have been able to avoid a profound crisis or depression with increasingly loose monetary policies enabled by inflation, which has been under continuous downward pressure. At this point, however, it is far more likely that central banks will not be able to achieve a soft landing, as inflation is currently far higher. A number of reasons why stock markets have not entered a profound bear market, in spite of an impressive list of negative factors, including geopolitical tensions, persistent supply chain problems, tighter monetary policies, downward pressure on growth. Well, first of all, companies are still engaging in massive share buybacks. Second, companies continue to issue better than expected earnings data. Third, global monetary policy is still very loose. Money creation is still very high, especially from the Bank of Japan and the ECB. And then fourth, there are few alternatives apart from equities. And as a result of those positive factors, the decline in equity prices is likely to be limited to around 10% from current levels. We expect another uptrend in the ensuing period once the downward pressure on growth and inflation prompts central banks to indicate they will be more cautious about tightening policy, and once the negative impact of Chinese lockdown measures and the Ukraine war gradually diminish. If we look at residential investment, also an important early warning signal for oncoming recessions, particularly because residential investment is so tied in with interest rates. The key question, therefore, for investors is whether the housing market in the US will enter a deep freeze or merely cool down. We think the latter is more likely. The 30-year fixed mortgage rate has increased nearly 2 percentage points since last August, admittedly, but at around 5%, it is still below the average of 6% that prevailed during the 2006 housing boom in the US. Moreover, the supply of new houses remains constrained. The national homeowner vacancy rate stands at record lows, and building permits are near cycle highs. Relative to incomes, despite real home prices being close to record highs, relative to incomes, US home prices have not broken out their historic range. So these are the investment conclusions from BCA, particularly on the US market, but also relevant to global markets. The widespread availability of Paxlovid later this year, this is a curative for COVID-19. In contrast to the vaccines, is effective against all COVID strains and will also be suitable for anti-vaxxers. It will help boost global growth while relieving supply chain bottlenecks. The central bank monetary policy outlook. Although central banks are going to raise rates at a rapid pace, monetary policy is unlikely to turn restrictive in any major economy over the next 12 months. So the conclusion, investors should remain modestly overweight equities over a 12-month horizon and look to increase exposure to non-US stock markets, small caps and value stocks over the coming months. And finally, from BCA, the dollar should peak during this summer and then weaken over the subsequent 12 months. The credit markets often send out a very important signal referred to by many as the canary in the coal mine. MRB have this to say about the credit markets. Forewarning signs of bigger trouble ahead for stocks continue to monitor credit spreads, which so far have stayed fairly calm despite the bearish bond market backdrop. And MRB conclude, to be clear, we are not expecting a recession anytime soon. The US economy is in solid shape with ample underlying support. The Euro area service and tourist sector will soon receive a material boost from reopening. And the Chinese authorities are providing some offsetting stimulus. And clearly the lockdowns in China will not last forever. Saracen, the conditions for long-term yields and inflation expectations are likely to start forming a top. And those conditions for forming a top are slowly falling into place. Moving on to the US, this is from MRB. Unemployment is often overlooked as an investment timing tool. At this point, the behavior of unemployment remains consistent with an ongoing economic expansion. The labor force is back to its pre-pandemic level, but there are roughly 4 million more job openings. The savings rate has dropped back to 6.2%, but savings continue to accumulate and sit at about $2.4 trillion above the pre-COVID trend. So on that bright note, Gielie, it's over to you on the local side.
Hi, Nick. Thank you very much for the comprehensive macro overview. It's always good to hear the facts rather than the fake news. Foreign investments, always interesting. The net buying for the week year to date was 15 billion rand, and that was down from the previous week of 17 billion rand. So people were actually selling some of their investments. There's a bit of statistical news. The inflation rate came out just after last week's meeting. It was reported at 5.9% at the higher end of the range, up from 5.7%. The core inflation rate was 3.8%, up from 3.5%. And then it's not always good news. The leading business indicator for February, that's a month-on-month figure, was minus 0.1%, and that is down from 1% in January. It's quite a big drop, that. And the PPI figure was also a disaster. It has been above 10% for 3 consecutive months. The PPI figure is now close to 12%, it's 11.9%. Now the PPI figure is the prices at the factory gate, and that later, much of that goes through to the inflation rate. So the outlook for the inflation is really negative. Good news is that the money supply increased from 6% to 8% in March. And the private sector credit extension nearly doubled from 3% to nearly 6%. And the balance of trade was also nicely up. It was up from $11 billion, that is for March, to $15 billion in March. The ABSA manufacturing index, it really took a knock. It came down from 60 to 50.7, and they described that to the effects of the floods and riots in Natal.
Thank you, Gielie. Thank you for your very comprehensive report.